the subject of fundamental of investment. In today's lecture, I'll be talking about valuation of equity shares. Friends, if we categorize the financial assets in broader categories, I would say there are two broad categories. One is fixed income securities and other is variable income securities. In the fixed income securities like bonds, like bank fixed deposit, public PPF, these type of the investments are called the fixed income securities. On the other hand, there are variable income securities where the income varies, that the value of the financial assets also keeps on changing and the income that is generating by that asset in that asset also keeps on varying. And the main category in that is the equity shares. So how you will value equity share, how the equity shares are being valued, this is the subject of discussion. In the fixed income securities, but again I'll go back to the fixed income securities, especially if I talk of bonds. Valuing bonds or debentures is comparatively easy as compared to equity shares, because the stream of inflows, stream of income that the investment of bond will provide to an investor is easy to predict. That is, when you invest in a bond, the company offers you a fixed rate of interest. That is, if the company offers 8% debentures, then the company every year, if it is a one debenture is of 100 rupees, every year will provide you 8 rupees as a dividend on one debentures, as a interest on one debenture. And debentures are normally being issued for a fixed tenure. That is, if it is a 10-year debenture, so after 10 years, the company will pay 100 rupees or as a predetermined price, it will redeem the money, it will pay back the money. If it is a 100 rupee debenture and the company promises to pay 100 rupees at the time of the expiry of the tenure of the bond, so after 10 years, the company will pay you 100 rupees, the principal amount which you have invested, and in the 10 years, during the 10 years period, at the end of each year, company will provide you 8 rupees interest as in form of interest. So what I am trying to say by this is that the inflows, the regular inflows of income, the money that will be generated by investment in a bond is determined, is fixed, and after the tenure, what price investor will be getting, this is also decided, this is fairly decided. So valuing that investment, valuing that financial assets is easy as compared to the equity share, because in the equity share, on the other hand, the income of the equity shares keeps on varying, because it is a ownership right, and in the ownership right, the dividend which the company will give to the shareholders, that will depend on the level of income, the income that will be generated by the company, its investment policy, the dividend policy of the company is whether the company wants to retain the profit for the purpose of the future expansion or growth, or it want to distribute the dividend. There are various factors which determines the dividend policy of the company, and the value of the share will also depend on the performance of the company. If the company performs well in the stock market, the company's share will also do better, right? Means the price will go up, people will be ready to pay more price for that share where the company is doing well. If the company is not able to perform very well, then in that case, the company's share does not command a very high price. The point I am trying to make is that what will be the value, what will be the income that will be generated, what will be the cash flow that will be generated by the investment in the equity share, that is not decided, that is not fixed. It varies, it depends on various factors. And as you know that equity share is a ownership right. Being the ownership right, it is again that there is no life, there is no finite period like bonds. I said the bonds are being issued for 10 years, so after 10 years the company will pay back the money. But in case of equity share, we presume that the company will continue forever. So since company is a going concern concept, so presuming going concern, it will continue, so there is no finite life of the company. So what will be the money that you will be getting at the end of the life of the company or at the end of the period? It is not also predictable. What it means is that valuing equity share is difficult because the stream of income, let me repeat, that the stream of income that investment will provide you in form of dividend, that is also not fixed. The money which you will be getting after a period of time, that is also not fixed, right? And the amount of dividend which you will be getting depending on the dividend policy of the company. So these are the various factors which affects the valuation of equity shares. That's why the valuing the equity share is little bit more typical as compared to the valuing of the fixed income security, or if I call it a bond, right? So the bonds are easy to value, but as compared to the equity share, which is difficult to value. Now the question is, when an investor wants to invest in equity share, I mean, when you are investing, you always want that you should invest in an asset. You will invest in a financial asset that is having the worth of your investment price, right? So means there should be some parameters on the basis of which an investor can decide that whether this investment, the price at which the investor is investing, it is the right price or not. For this very purpose, we try to value the equity shares. So equity share capital exhibits the ownership interest. I've already said, investors, individuals and institutions prefer to invest in equity shares because of the twofold motives. That is, when I'm saying the income is more predictable in bonds, in debentures, but the stream of income that will be generated by shares is not predictable, but still people want to invest in bonds, in the equity share as compared to the bonds, those who are ready to take risk, because the investment in equity share will give a stream of income in the form of dividend, and that dividend can be, I'm not saying must be, may be more than the income that is generated by the bonds in form of the interest, fixed interest. The other reason is that at the time when you will sell it, the price at which you will be selling it, you are expecting, an investor who invests in the equity share, he expect that he will be selling at a price which is more than its price of investment. That is the price at which you are investing in a share. Say for example, if I am investing in a share at 100 rupees, I am presuming that after 3 years, if I will sell it, right, so it will give me a money, it will give me a price which will be more than 100 rupees, right, say 120 rupees. So I will be getting, not only for 3 years, I will be getting income in form of dividend, but also I will be getting capital gain, means I will getting capital appreciation in the form of 20 rupees per share if I invest in a share. This is merely presumptions of an investor. So to receive capital gain at the time of sale. So theoretically, the valuation of equity share is the most typical because of the residual ownership character, right? They receive the leftover profit and remaining assets in case of liquidation. Supposing a company is being, means, right, what it means is that at the end of the period when you want to suppose liquidate the company, and in that case when the company is being liquidated, whatever is left over after paying all creditors, the whole money belongs to the shareholders. So it will be distributed among the shareholders. So valuation helps in finding the true value of or fair value of a share before taking any investment decision. When you are taking an investment decision, you would like to calculate the fair value of that share, right? That is, supposing in the market, stock market, the price is X. At this price, when an investor is investing, investor would like to know that whether this is the right price of investment, because you would like to invest in only in that asset where the intrinsic value of the asset is more than the price at which you are investing. Suppose I am investing in a share and I feel and I calculate and expect that the value, the real worth of the share is say more than 100 rupees and the price at which it is commanding in the market is 100 rupees. So I'll like to invest in such share where the intrinsic value is greater than, means in my opinion the value of the share, intrinsic value of the share is more than 100 rupees and this share is available at 100 rupees, so I should invest in that share, right? So the valuation of securities becomes an important element of portfolio management and security analysis. But there are certain assumptions on the basis of which we value equity shares. There are different methods for the valuation of equity shares which are based on following assumptions. There is no redemption date of equity shares, means there is no fixed date on which you will be redeeming. They do not have any fixed redemption value. The price at which the shares will be redeemed, there is no fixed, means unlike the bonds where you can say that at the time of the expiry of the life of the bond, if it is being issued for say 10 years, so after 10 years what the company will pay, the redemption value is fixed. But in equity share, if you invest in an equity share for 10 years, right, after 10 years, what will be the price of the share, that is not fixed. So the redemption value is not fixed. And thirdly, there is no guaranteed dividend on equity share, right? So means unlike in the bonds where the dividend income, where the interest income, not dividend income, where the interest income which you get on the bond is fixed, but in case of the companies, the dividend income on equity share is not fixed. So there are different approaches. One of the approach of the valuing of equity share is the valuation based on accounting information. Means if I say approaches, there can be two different approaches. One is called the accounting information basis, means on the base of accounting. The other is called discounting cash flow techniques, right? I'll be discussing the discounting cash flow technique later on. At this moment, I'm saying if we are valuing equity share on the basis of, or we are valuing equity share on the basis of accounting information. So accounting information, valuation based on dividend and valuation based on earning valuation of shares which does not pay dividend, means those companies which pay dividend and those companies which do not pay dividend. Suppose the company do not pay the dividend, how you will value the share, and if the company pays the dividend, how you will value the share. The financial statements, mainly the balance sheet, income statement and cash flow statements, provide adequate data to find out the value of equity shares. So there are two important or popular valuation model as per the accounting information is concerned. One is called book value or balance sheet valuation method. The other is called liquidation valuation method or liquidation value. So how we calculate? Let me tell you very briefly how we calculate the value of a equity share on the base of book value and on the base of liquidation value. See, what is book value? What book value is nothing but the accumulated, that part of the earnings that belongs to the shareholders. So the value of an equity share can be easily calculated by dividing the book value of the company's ownership by the number of equity shares. So the total book value of company's ownership, right, divided by number of shares. Say for example, in a company which has issued 10 lakh equity shares and 1 crore rupees is the equity capital, and over a period of time it has accumulated reserves in the form of accumulated profit is say 10 crore rupees, right? So 10 crore rupees plus 1 crore rupees the share capital, that comes to be 11 crore rupees. This 11 crore rupees is the book value, right, divided by 10 lakh shares. So 11 crore divided by 10 lakh share, that will be the book value per share. So book value of firm's ownership is the sum total of total payable including equity share capital plus accumulated profits minus accumulated losses if there is any, right? So suppose the company is making a losses over a period of time, it doesn't have accumulated profit. So from the share capital you will deduct the accumulated losses, right? So that will be the total book value of the company, and if we divide on the base of the number of shares issued, that will be book value per share, right? So book value is equal to equity share capital plus accumulated profits minus accumulated losses divided by equity shareholders number of equity shares. But since book value has historical nature, so it is difficult to accurately measure the value of equity share. One of the drawback of valuing equity share on the base of the book value is that in the balance sheet, as we know, we follow the historical method. So whatever the actual money is, means actual profits are on the base of historically, right? We don't change as per the price value or as per the price appreciation, right, of the asset that are there in the company, right? So in this case, the historical basis is the basis of valuing the company, right? So it is one of the limitation of valuation of the on the base of book value is that it is based on historical valuation. The other is called liquidation value. Means we are talking of the accounting information, how we value the equity share on the base of accounting information. So accounting information, we are saying there are two methods, either on the base of book value or the other basis is liquidation value. Liquidation value means if the company is being liquidated today, say, right, what is the total sum of money that the company will be getting if the company is being disposed of, liquidated today, right? So, and whatever is left out from that money, whatever is left out after paying to all creditors, means all outsiders, bondholders, banks and all those creditors, right? Whatever is left out, that belongs to the shareholder. So, the money that is being left over will be divided amongst the shareholder. On that basis, the shares are being valued. So, liquidation value is the net amount received by the company if all its assets are sold and liabilities are paid, right? So, this method has its own limitation, because valuing at right price at which the company can be liquidated is a big challenge, right? So, this method is more practical as compared to book value method, since it is based on current realization value instead of book value. But what is the right price at which the company can be liquidated? Finding the right price is a challenge. Because of this reason, the liquidation value has its own disadvantage or own limitation. So, liquidation value requires finding out the realizable value of all assets, which is a complex task. So, basically, as for the accounting informations are concerned, these are the two methods. One is called book value method, the other is called liquidation value method. Now comes the other method of valuing the equity shares is valuation based on dividends. By and large, equity shares are being valued on the basis of this very method, that is, and we also call it discounted cash flow technique, right? In the discounted cash flow techniques, what we do, that we discount the future incomes, future receipts with the cost of capital, which is the minimum cost of capital. In our case is the minimum return which the shareholder, which the investor wants to get out of his investment or out of her investment, right? So, the stream of cash flows that investment will provide to the investor will be discounted by the cost of capital of that investor, and that will be the value of the share. So, now let me discuss how you value the dividend, how you value the shares on the base of dividends. So, valuation of equity share based on dividends has the following assumption. There are certain assumptions on the base of which we value equity shares in the dividend model. The dividends are paid every year. We are presuming that the calculations which we do and the way I will explain it, I am presuming that the dividends are paid every year at the end of the year. The first dividend will be paid after 1 year from the date of the purchase, right? So, when you are purchasing at the end of the first year, the dividend will be paid. The equity shares will be sold at the end of the year and at X dividend terms. Means X dividend means after receiving the dividend. Means if I hold the share for a year and I disposed of, that I will be getting dividend amount, plus after getting the dividend I will be selling after a year. I am presuming I am holding the share for a year, right? An investor may plan to hold shares, means holding period is predetermined. Now, how you value the equity shares in the dividend model? One of the method is that we are presuming that holding period is pre-decided. I am buying a share and I am planning to sell it, say, after a year or after 3 years, after 4 years, after 5 years. Means for what period I will be holding the shares, that is fixed. That is fixed in the sense I have made up my mind that if I am buying a share, I am buying the share for 3 years and I will be getting dividend income for 3 years, and after 3 years I will be selling the share at a particular, I am expecting that after 3 years that this share will give me this much price. With this assumption, I'll try to find out at what price should I buy it, means what is the valuation of the equity share. So an investor may plan to hold shares for a predetermined period and estimates expected dividend payment annually and selling price at the end of the holding period. There are two cases, 1 year holding period and multiple year holding. So means if my holding period is 1 year, then how I will value the share? If my holding period is more than 1 year, say 5 years, 3 years, 6 years, 10 years, 20 years, what will be the value of the share, right? First, let me take a case where my holding period is 1 year. So when an investor holds shares only for a year and seeks to ascertain its fair price, he needs to make an estimate of this year, the year and dividend and selling price. Means the first case which I am taking is that in case an investor assumes that investor will hold the share, buy the share for 1 year, and in 1 year he expects that after the end of the year he will be getting this much dividend, and when he will sell the share at the end of the year, what will be the price he is expecting from a share, right? So with these two assumptions, means these two estimates I would say, right? One is the dividend, that what dividend I will be getting after the end of the year, and second is what price I am expecting at the end of the year. So my holding period is 1 year. If my holding period is 1 year, what will be the price of the share, right? So let me explain you with an example. What should be the present value of the share if the company expects to pay dividend of rupees 3 per share after 1 year, and the expected value of a share after 1 year is rupees 90, right? And the required rate of return is 15%, right? So there are three things that the individual who is investing in a share is expecting, that after the end of the year, the investor will be getting 3 rupees dividend. And at the end of the year, the investor expects the share in which the investor is investing will give him a price of rupees 90. And thirdly, the required rate of return for the investor is 15%. Means he would, the investor wants that minimally 15% return he should get, which we call it cost of capital is 15%, right? So if 15% is the cost of capital, what will be the price of the share? At what price should the investor should invest? So in this case, we use a formula P0. P0 is called the current price, means price in the zero period, right? Is equal to D1 divided by 1 plus KE. D1 is dividend at the end of the year. KE is our cost of equity, plus P1, the expected price at the end of the year, which in our example is rupees 90, divided by 1 plus KE. KE in our example is 15%. So this formula is equal to P0 is equal to D1 plus P1 divided by 1 plus KE. So D1 is 3 rupees in our example, P1 is rupees 90 in our example, cost of equity is 15%. So 3 plus 90 divided by 1.15. This comes to be 80 rupees 86 paisa, right? So what should be the valuation of this share if I am having these three assumptions? That is, the company will give me 3 rupees dividend at the end of the year, the price I am expecting at the end of the year is rupees 90, and my expected return, which is called cost of capital, is 15%. That I want that on my investment I must get the amount of risk which I am taking, it must give me a return of 15%. So if this is the scenario, then the share or the price at which I should make the investment or the valuation of the share should be P0 is equal to D1 plus P1 divided by 1 plus KE, that is 3 plus 90 divided by 1.15. That comes to be 80 rupees 86 paisa in our example. Means the right valuation of this equity share at present, the zero period P0, is 80 rupees 86 paisa. So friends, in this lecture, what I have explained is the valuation methods of equity share. I will be continuing in the next lecture also that basically there are two techniques. One is called accounting technique, other is called discounted cash flow technique. Before talking this, I said that valuing equity share is more challenging as compared to valuation of bonds, because when you value the bonds, the flow of income which the bonds will provide, flow of cash flows which the bond provides is predictable, because normally the interest amount which the bond holders gets also is predetermined. The amount at the end of the life of the bond, what the investor will be getting, is also fixed, right? Is predetermined. So valuing that is easy. But in equity shares, the stream of income that is in form of dividend, in terms of the redemption value of a share when the investor will sell it, it is unpredictable. That's why it is more challenging, it is more difficult to value equity share. But nevertheless, there are different techniques on the basis of which we value the equity share. So one of the technique we discussed is that the dividend model, and where I am presuming that dividend, we are selling the share or the investor is selling the share after a period of time, after a year, and the amount of dividend is given, the price which the investor expects is given, and the cost of capital is given. So on that basis, how the value of the equity share will be calculated. We will continue this in the next lecture. Thank you.